The rate on your property loan has been calculated the same way for 30 years. From this year, it won't be, and most people borrowing right now don't know it's changed.
Welcome to a special report from CanDoo World. CanDoo World bridges the world between real estate and AI and provides real estate advisory services and AI training. I'm Sarah, joined as always by David, and today we're going somewhere we haven't gone before, into the plumbing of South African property finance. Not the rates you read about after an MPC meeting, the benchmarks behind those rates, the reference points that translate repo decisions into actual rand amounts on actual bond statements. Those benchmarks are being replaced. The rewiring has already started. And this week, this literal week, a major part of that switch happened. So let's walk through what it means, why it matters, and who needs to pay attention.
Before we get into the structural story, a quick anchor on where rates sit. Prime is at 10.25%. The March MPC meeting was a unanimous hold, the second consecutive pause after 6 successive cuts that delivered 150 basis points of easing from late 2024 into 2025. That easing cycle is done for now. The SARB revised its 2026 inflation forecast upward. A Middle East conflict has pushed fuel inflation projections above 18% for the second quarter, and headline CPI is expected to push toward 4%. Our view. The expected cuts in interest rates have been deferred, with the risk being that the next change in interest rates may be up.
And the major banks aren't even agreeing on what comes next. ABSA is holding firm. They see rates unchanged for the year. Standard Bank still sees cuts coming. FNB is forecasting 1 or 2 reductions as investment spending recovers. Nedbank is cautious. The Reserve Bank's own projection model sits between the optimists and the hawks. It's an unusually wide spread of views for institutions that look at the same data.
There's also a squeeze for investors. National rental yields average roughly 7 to 9%. Gross. Prime is 10.25. If you are a leveraged residential investor on a standard home loan, your interest cost is outrunning your gross rental yield before operating expenses like rates and taxes, levies and repairs. That's a potential negative carry position if you used a lot of debt to buy that investment apartment. It doesn't mean property investment is wrong. It means the rate environment is squeezing anyone who borrowed to buy.
That's the weather. Now let's talk about the climate. Because against that backdrop of a frozen, uncertain rate cycle, the deeper change is already underway, and it affects every floating interest rate loan in the country. David, most South African property investors are familiar with prime and repo that the South African Reserve Bank sets. But JIBAR, the Johannesburg Interbank Average Rate, is the benchmark governing commercial property loans, developer finance, the bonds listed property companies issue. What is it, and why is it going?
JIBAR has been the heartbeat of South African institutional finance for decades. As at mid-2025, it governed roughly 43 trillion rand in domestic financial exposure. Globally, exposure to JIBAR-linked contracts exceeded 100 trillion rand. Those are not small numbers. It's the rate commercial property banks quote as 3-month JIBAR plus a margin. And critically, it was forward-looking. The rate was fixed at the start of the quarter. You knew what you owed on day one. Cash flow certainty.
So what went wrong?
The foundation it was built on shrank. JIBAR was calculated from negotiable certificates of deposit, a specific type of wholesale bank funding instrument. By 2023, those instruments accounted for less than 5% of actual wholesale bank funding, so a benchmark governing 43 trillion rand in exposure was being calculated from a puddle. And after the global LIBOR manipulation scandals that surfaced post-2008, where some banks were shown to have submitted false quotes to move rates in their favor, regulators worldwide mandated that benchmarks be grounded in actual transactions, not expert estimates, not panel submissions, real trades.
South Africa, as a G20 member, had to align.
Correct. The Reserve Bank, through a body called the Market Practitioners Group, identified a successor, ZARONIA, the South African Rand Overnight Index Average. It tracks 361 billion rand in actual daily wholesale overnight deposit transactions, volume weighted with the top and bottom 10% trimmed to remove outliers. It's real market activity, calculated by the Reserve Bank itself. The contrast with JIBAR is stark. One benchmark built on a 5% sliver of the market, one built on the deepest part of it.
So ZARONIA is more reliable, but there's a catch for borrowers, particularly commercial borrowers.
The big catch is timing. JIBAR was forward-looking. ZARONIA is backward-looking because it's based on actual data. Under JIBAR, the rate for the quarter was set on day one. Under compounded ZARONIA, The daily overnight rate accumulates across the quarter, and the final interest bill is only known near the end of the period. The Market Practitioners Group's practical solution is a 5-business-day lookback, meaning Treasury teams get roughly 5 days' notice before payment is due.
5 days for a larger-scale commercial developer and investor who is simultaneously managing distributions, operational costs, and debt service.
5 days. It is, to be fair, better than 0. And there is a potential forward-looking version called Term ZARONIA being developed, targeted for an April 2026 launch, which would be derived from derivatives market expectations and give borrowers upfront rate visibility. But regulators have signaled it will face restricted use. The robust standard remains ZARONIA.
And the transition is not theoretical. The No New JIBAR event passed on March 31st. Any loan written after that date cannot reference JIBAR. JIBAR itself publishes for the last time on December 31st, 2026, full ZARONIA regime from January 1st, 2027.
And this past week, major international clearinghouses LCH and CME switched their discounting curves to ZARONIA. The derivatives market has begun repricing existing swap valuations against the new benchmark. It's not a future event, it's the present.
For existing JIBAR linked contracts that can't be renegotiated, there is a legislative backstop, the General Finance Laws Amendment Bill, which empowers the SARB to designate replacement benchmarks for so-called tough legacy contracts. Public comment closed in January. To preserve economic neutrality in the switch, a fixed credit adjustment spread bridges the gap between the old and new rates. For the standard 3-month JIBAR tenor, that spread is roughly 16 basis points.
Thin margin, but it matters. The intent is that no party is made worse off purely by the transition mechanics. The commercial integrity of existing deals is preserved.
David, you flagged 2 losses, 2 things that change when JIBAR disappears, and I want to make sure we land both of them clearly.
Yes, the first is timing certainty. Under JIBAR, day 1 you knew. Under ZARONIA, you find out near the end. 5 days is all the warning you get. That's loss 1. Loss 2 is less obvious, but arguably more significant for sophisticated investors. JIBAR was an anticipatory rate. If the market expected the Reserve Bank to cut at the next MPC meeting, JIBAR would start drifting downward before the decision. Rate relief bled in gradually. Borrowers got a gentle preview, a kind of early warning system embedded in the rate itself. ZARONIA tracks the repo rate with precision. When the Reserve Bank cuts, ZARONIA drops the next business day. When the SARB holds, or hikes, the same immediate transmission applies. There is no anticipatory drift, no bleed-in, no preview. The full benefit of a cut and the full pain of a hike both arrive almost immediately. For institutional borrowers who have spent years positioning around MPC meetings, that anticipatory advantage is gone.
So, to put it plainly, under JIBAR, you knew what you owed before the quarter started, and you felt rate changes before they happened. Under ZARONIA, you find out what you owe near the end, and you feel every Reserve Bank decision the day after it lands.
That's the transition. Because the instinct will be to say, the rate itself is the same, just the name changed. It's not. The timing structure is different. The anticipatory behavior is different. For a developer with a 500 million rand construction facility, those differences are not insignificant.
Now, here's the part of the story that most people have missed entirely. ZARONIA is replacing JIBAR in wholesale and institutional markets, but it is not, and legally cannot, replace prime on your home loan. Why?
The National Credit Act. Under the NCA, the total cost of credit, including the interest rate, must be disclosed upfront in a pre-quotation agreement before you sign anything. ZARONIA is backward-looking. The rate is only finalized near the end of the quarter. You cannot disclose what you don't yet know. It is not a preference. It is a legal requirement. ZARONIA for retail home loans is off the table entirely.
Which is why the Reserve Bank has put a separate consultation paper on the table, proposing to retire prime itself and replace it with something called the SARB policy rate, SPR.
And this is the story most homeowners haven't heard. Prime has been the familiar anchor for South African property borrowers for over 2 decades. The Reserve Bank's consultation paper, published in February 2026, proposes that from 2027, home loans will be quoted as repo plus X%, rather than prime minus Y%. Economically identical, Prime is already just repo plus 3.5%. But the framing changes. Prime minus 0.5% is a phrase every South African borrower understands. Repo plus 3% is the same number, but it doesn't feel that way yet. The stakeholder comment period for this proposal closed on March 20th.
The Reserve Bank's argument is that the current prime construction creates a misconception. Borrowers negotiate below prime and assume the 3.5% difference is pure bank profit. The SPR model makes the actual bank margin clear and transparent.
Which is reasonable, but clarity and familiarity are different things. South Africans have spent decades thinking in prime. The shift will land when it lands, and it will require banks to educate an entire country of borrowers on how to read their bond statements.
So here's where we are. The rate cycle is frozen. The cuts that were expected haven't come, and the banks don't agree on whether or when they will. Against that backdrop, the benchmarks that translate Reserve Bank decisions into actual bond repayments are being replaced. JIBAR is gone from new contracts. It ceases entirely in December this year. ZARONIA is live in institutional markets, and this week's derivatives switch confirmed it. Prime is next, proposed for retirement from 2027. The transition is already underway. If you're a commercial property developer or investor, your finance team needs to be working through your JIBAR exposure. Every loan, every hedge, right now. If you're a homeowner, the immediate impact is manageable, but the framing of your bond statement will eventually change. The number will be the same. The language will be new. We'll be watching how the SARB policy rate, or SPR, consultation process develops and what the final transition framework looks like for residential borrowers. That story has more chapters to come. Thank you for joining us for this special report. And please like and subscribe so that you can get notified when we release new reports on the South African property market. From David and me, stay informed and stay ahead.